Last time gold really moved, which was the year 2000, it moves from a low of what, $250 to 1900 over 10 years. So what I was trying to say was not specifically 18 months, but merely that the move was getting started and had some legs. As to the time, I wouldn't pay too much attention to the date. I would pay attention to the level of real interest rates. If you saw the interest rate on the U.S. 10-year Treasury at 7% and you saw the underlying rate of inflation at 4%, in other words, if you were getting 300 basis points in real yield, then exit the gold. I don't think you're going to see that.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a well-anticipated guest, Rick Rule, the CEO of Sprott Asset Management, joins us again this Wednesday, August 5th, 2020. Rick, thanks for coming back on the show.
Always a pleasure. Thanks for having me back.
It was quite an honor to be able to participate in the Sprott Natural Resources Symposium last week, the virtual symposium, and the glow is still fresh in everybody's mind. We had so many visitors into our booth over the period of 72 hours. We had almost round-the-clock coverage on different shifts, and we had anywhere from typically several visitors from conference attendees joining us, and we also had various speakers joining us in the booth, and sometimes that caused impromptu panel discussions to come up, which was very fruitful, and we're still getting emails and contacts from the people who attended that they really valued that new virtual format. So kudos to you and the team for putting together a virtual conference when we couldn't do the physical one.
And to you get out of it what you put into it, and you guys put a lot into it. You know, there's no real secret. Success is a function of hard work.
We have a lot of questions from viewers. I know our time is limited, so we wanted to jump right in. People are no doubt noticing at this time the breakout of gold and silver from trading ranges, and in the case of gold to all-time nominal highs, and showing a lot of strength from the silver as well with multi-day, multi-dollar moves, that kind of thing going on. You've been telling us to watch for some time. You said, when will silver move? Well, it's easy. It moves when it does. And we're certainly starting to see some of that now. Could you give us your updated perspective on the major factors that are driving the gold and silver markets? And perhaps one of those might be Sprott having announced a major program to start acquiring physical silver, but perhaps you'll tell us where that fits into the bigger picture.
Sure. We've had part of this discussion before in various interviews, Dunnigan, so I would advise people who are curious about the topic to look through your archives. I advise them to do that because looking through the archives accidentally makes us look really smart. Over the last year and a half, you and I seem to have nailed the gold and silver price reasonably well, even in terms of timing. So now that I'm done patting you and I on the back, I'll move on to the question. My belief is that gold moves for many reasons, but primarily it moves as a consequence of people's lack of faith in the ongoing purchasing power of savings instruments, bonds, and deposit products denominated in fiat currencies, but particularly in the world's reserve currency, the US dollar, which has been for 50 years the default investment around the world. If people are concerned that the interest rate that they receive on their savings isn't sufficient to compensate them for the time value of money, for the depreciation of the currency, and for the risk that they take associated with that investment, gold does well. And I think people's fears today are founded not so much in partisan politics, although they make me fearful, but rather in simple arithmetic. The stated yield on the U.S. 10-year Treasury, which is the world's benchmark security, is about 50 basis points. A 50 basis point yield in a currency that the Congressional Budget Office says is deteriorating by 1.6% compounded. And where, by the way, their target deterioration, which is a different way of saying their targeted rate of inflation, is 200 basis points. What that means is that if you give your money to the U.S. federal government for 10 years, they absolutely promise to give you back substantially less than you gave them. And I, for a change, believe this promise, as do many people. It's difficult to believe that in the month of July alone, deficit spending in the United States of America was almost $900 billion. This isn't an annual deficit. This is a deficit that took place in 1 month. Now, how did they meet that gap? Well, mostly through quantitative easing, which if you and I did it was counterfeiting. So if you believe that the next president, whoever he or she may be, will deal with spending and deal with borrowing and deal with quantitative easing, you probably shouldn't own gold. In other words, if you feel good about the return of real interest rates, and if you feel that fiscal stability, fiscal sanity is going to return to the United States or other countries, you have no reason to own gold. If you express some trepidation in that point of view, perhaps you should own gold. Moving on, we have talked for a long time, you and I, about the fact that the first mover in precious metals is gold. That gold establishes the pattern because it's the fear buyer. And when that momentum is established, then silver comes along. But silver traditionally moves further and faster after it's followed gold's lead. And we've seen just in the last 60 days evidence that now that gold has moved, silver is beginning to fall in place. And not surprisingly, as it has in 8 prior recoveries from oversold bottoms, the silver is starting to move faster than the gold, getting less attention, of course, because the move was established by gold. Gold is the brand name, if you will, for precious metals. But the move that we've seen in silver, and even a little more lately in the silver stocks, is consistent with market activity over the last 40 or 45 years. Are the stocks overbought? Maybe the little tiddly juniors, the sub 100 million market cap companies, most of which technically don't have any gold or silver. They're looking for gold and silver. I think that market's getting very, very, very frothy. Doesn't mean it can't continue higher, but very, very frothy. But my own feeling is that although we will have volatility in metals prices, that unless sanity prevails among the electorate, something I've seen very little evidence of in my life, that you are well positioned as a defensive player owning gold and probably well positioned as a speculator owning silver.
There was a rather infamous title that came out on an interview you did earlier this year that something about, I'll start selling my gold in 18 months or something like that. Vanessa asked, does Rick Rule still believe investors should exit gold in 18 months, which is what Rick said in May? Thomas Jackson said, I think he said at least 18 months.
I did say at least 18 months because there was a lot of discussion about that at that point in time about the fact that gold had moved. Yes, it had moved. But if you look at the move that we enjoyed from $1,100 to $1,500 or $1,600, if you put that in a historical context, I mean, you're talking about a pimple on an elephant's butt. Last time gold really moved, which was the year 2000, it moves from a low of what, $250 to $1,900 over 10 years. So what I was trying to say was not specifically 18 months, but merely that the move was getting started and had some legs. As to the time, I wouldn't pay too much attention to the date. I would pay attention to the level of real interest rates. If you saw the interest rate on the U.S. 10-year Treasury at 7% and you saw the underlying rate of inflation at 4%, in other words, if you were getting 300 basis points in real yield, then exit the gold. I don't think you're going to see that. Now, understand that gold and gold stocks or gold and gold mining juniors are different asset classes. And they're going to move at different points in time, and they're going to have different risk-reward probabilities. So if gold really catches a bid with the Robin Hood crowd, as an example, and the gold stocks begin to really outpace gold, particularly the sub-$100 million market cap speculative stocks, it may be time to exit that sector. Notice I said may, please, Dunnigan. It may be time to exit that sector this year. They can get ahead of themselves, and we are in nothing but a speculative frenzy around the world.
You mentioned some of the gold mining stocks. We had the pleasure of speaking with Sandstorm Gold Royalties yesterday. They're one of the invited sponsors of the Sprott Symposium. And in the past, you've talked to us about what differentiates royalty and streaming companies from gold miners. But David Mayberry asked, Mr. Rule, would you briefly cover your criteria for exceptional precious metals mining stocks?
Margin. Exceptional precious metals mining stocks generate good margins. That is, they produce gold all in, including finding cost and cost of capital, much more cheaply than they sell it. They have high quality assets, they have high quality people, and importantly, they have to have a pipeline in front of them. They have to have projects so that they can maintain their level of cash flow. One of the many mistakes that investors make is they put too much emphasis in gold mining on price earnings ratios. The reason I say that that's a mistake is because mines are finite. And you can't project price earnings into the future because every day you mine, your business gets smaller. So you need a circumstance where you're focused more on net present value. That is, understanding the margin that will be enjoyed on production for the next 10 years or 11 years or 12 years, and trying to come to a net present value of that cash flow stream using a matrix of gold prices. I may believe that gold's going to $2,500 as an example, or $3,000, but my belief is not a fundamental. So I need to test that cash flow multiple at $3,000, at $2,000, and at $1,200. I need to understand the range of probabilities in pricing. But that's a very long answer to saying net present value and margin are the key determinants. Now, of course, and we've talked about this in interviews before, for in particular the royalty companies, but also the streaming companies, their margins are built in. In a royalty company, as an example, where you have no acquisition cost after the initial capital cost, your gross is your net. That's a very nice business. That margin after depletion and depreciation, probably 97%. And in the case of the bigger companies like Franco-Nevada and Wheaton, where their cash flows are gigantic relative to their general and administrative expense, their management expense ratio, which is how much money it takes to manage that cash flow, goes as low as 12 basis points with Franco-Nevada. These are truly astonishing businesses. If you think about 85% operating margin, and then a less than 0.5% general and administrative burden, particularly in the case of Franco and Wheaton, where their reserve life index is measured in the decades rather than the months. These are truly superior businesses. Now, they're priced as superior businesses, too. This is no mistake. I'm not the first guy that's figured this out.
Can we turn our attention for the moment to the COMEX and other commodities markets for metals? Sprott had recently made an announcement that it intended to increase its holdings of physical silver, I believe. Catherine J. Hernandez asks, rumors that COMEX is on life support, suffering piles of lawsuits. Seems to me that Sprott Asset Management is in the best and most unique position to do an unprecedented deal with the CME, take over that space, and offer the world's first free and fair market metals exchange, or better yet, just take the CME over altogether. Why? Because when ducks quack, feed them, quoting Rick Rule. So can you talk to us about what your view is of the likely health of the commodities exchanges and what role Sprott needs them to function as, and what role Sprott's actions may be having on the current activity on the metals exchanges?
I actually think the COMEX will survive just fine. Understand that the COMEX is really truly supported by the powers that be. I'm not a conspiratorialist per se, but I would note that if you caught too many COMEX participants short, they already allow themselves to cash settle. So this great fantasy that the silver bugs have that there could be a failure to deliver and all the guys on the other side would get sent to margin heaven isn't strictly speaking true, because they could cash settle. Our own silver, that is the silver that we use to back the Sprott Physical Precious Metals Trusts, is always good delivery silver. That is, it's in-system COMEX or LBMA silver. It is stored in bonded, vaulted facilities where we know something about the efficacy of it. And I should say that there is a broad shortage of retail silver product in the market now. We have had to buy as much as $50 million worth of silver a day in recent months. And although it's required a little bit of scrambling, there isn't currently a shortage of wholesale product. good delivery wholesale product. What there is a circumstance where in the United States, the market seems to be in very, very, very tight supply, while in London, the market is well supplied. The reason that we are told that that is the case is because the Swiss refiners, who have made a living melting down wholesale product like 400-ounce gold product and making it into 100-gram retail products, have been shut down as a consequence of COVID. So that trade hasn't been taking place, and physical inventory has built up in London at the same time that physical inventory has been depleted in the United States. But I should reiterate that at the institutional level, at the Sprott level, we haven't had any difficulty thus far in obtaining physical product. As to our filing, we note that for many U.S. holders, the Sprott product has or may have tax advantages in that it's taxed at the capital gains rate rather than at the collectibles rate. And the consequence of that is that our market share in silver has been expanding fairly rapidly, both as a consequence, I think, of the tax advantage and probably also as a consequence of the Sprott brand. And that meant that we wanted to have the availability to issue units to the extent that new investors wanted to buy the units to buy more silver. It was reported on several media outlets that Sprott had bought $1.5 billion worth of silver. That's not true. We asked the Securities and Exchange Commission and were granted permission by the Securities and Exchange Commission to issue a shelf prospectus that would allow us during periods of very high demand to issue new units and use the proceeds to buy physical silver as available. That's all we've done.
There's some concern with the potential strains in the banking system and the currencies. People are looking at their stability as they consider investing in either streaming companies or mining companies. They're thinking, do I really want to have my capital out there in brokerage accounts? The same time that they're thinking about, maybe I'd rather have it in physical metals, that sort of thing. Robin Peterson's question kind of echoes that. Rick, I've heard you give the names of a couple of banks that were most secure places to keep our money. Could you tell us which brokers are the most secure custodians for our stock market purchases? So maybe for those who missed the earlier ones, you could hit again which of the banks you felt had more legs to stand on than others, and then if there's anything you want to say about brokerages.
There's a number of solvent banks out there. The ones I'm probably most familiar with are Farmers and Merchants Bank of Long Beach, a fairly obscure but extraordinarily well-capitalized bank out here. Donegan, I think our last interview, I said it was an old-fashioned bank. It had money. First National Bank of Alaska, run by the Cuddy family, I think is quite a solvent bank. A little private bank that I'm a shareholder of called First National Bank of Hemet. When I say small, I mean infinitesimal. The banking regulators suggest that 7% capitalization, which is to say equity being 7% of total assets, is well capitalized. I disagree with that fundamentally. I would like to see a bank with at least 12% common equity as a percentage of total assets. Banks like Farmers and Merchants Bank of Long Beach are closer to 17 or 18%. I guess it depends on the risk of the asset classes, but unless you're a really, really, really good credit analyst, you're not going to have the ability to do too much qualitative work on those asset classes. With regards to the brokers, it gets substantially more difficult. You can request from any brokerage a copy of their focus report, which is their financial statement that they have to file with FINRA, the self-regulating organization. But again, the answer for most investors requires the investor themselves to have some knowledge of the assets underlying in the brokerage business. As an example, when I look at the J.P. Morgan Chase balance sheet, and by the way, I do balance sheets for fun. It's my idea of a good time. The idea that the notional value of their derivatives exposure is $60 or $70 trillion they'll tell you that the actual liability is much less because they've sold offsetting positions. That, of course, depends on the counterparty paying them. It's very difficult for me, for most of the big brokerage firms, to understand whether or not they are solvent. I understand perfectly their margin operations. If you see a big bank that has, $1 trillion in margin loans outstanding, and they have that secured against client positions of $2.2 trillion, given that the bank itself controls the collateral and can sell it to meet the margin call, I'm not unhappy about that at all. I understand the nature of that business. I've watched banks and brokerage firms deal with it for years. I've dealt with it myself, although we're pretty stingy margin lenders here at Sprott. What I don't understand are the swap contracts and the derivatives because they're deliberately made opaque. Buffett famously says you got two really, really, really smart MBAs on separate parts of a trade that settles in 15 years. And it's for $10 million, and both of them book a profit on the same day. Something is wrong. He doesn't know what it is. Neither of them knows what it is. The system doesn't know what it is either. But the truth is that something's wrong. We chose at Sprott to have our clearing firm be RBC Dane, a wholly owned subsidiary of the Royal Bank of Canada, which is Canada's most solvent banks and one of the most solvent banks in the world. And the real reason that I chose RBC Dane, aside from their relatively conservative margin policies, which although they might inconvenience me, I agree with, was the fact that their trading position in derivatives was a number I understood well, which is to say 0. They use derivatives to hedge their credit risk. I get that. But they don't use derivatives as a profit center. Mm-hmm. And among the various firms, and I think there were 15 that we looked at in terms of setting up clearing arrangements, the only balance sheet that I personally felt that I could understand sufficiently that I would trust my own money and my clients' money to was one where the over-the-counter and brokeraged derivatives position, net derivatives position, was 0. I thought a very good number.
Interesting. Well, that leaves some homework left to the students, but it sounds like we have reason for concern about maybe many brokerages that are out there. We certainly saw some go belly up back in the 2009, 2010 collapse.
Well, understand that, for the big financial services firms, the Fed will do whatever they can do. They say whatever it takes. Whatever they can do to keep them alive. In 2008, I remember the bailout that occurred, and I remember that Congress decided that they needed to authorize these enormous retention bonuses to keep these executives. There would have been no question, had they worked for me, about them getting bonuses. I might have paid them a little bit to leave quickly. But we need to understand the circumstance that confronts us. If there is any way in the world that the political class can save the financial class from their own stupidity, they will do it.
Looking ahead, we've got a couple of questions. We'll probably only have time for one of them about what comes next after this current gold and silver precious metals bull market run. Smartliner says, how to best transition from precious metals investments to base metals investments for the next wave? Which sectors are most likely to gain after the precious metals, uranium, copper, zinc, etc.? Others have asked about other asset classes that you'll be keeping your eye on as the precious metals bull run gets long in the tooth.
First of all, I think we have a ways left in the precious metals bull run. I really do. The determinant is going to be sanity in Washington, and I see no signs of green shoots in that regard. I don't feel as attracted at present to the industrial materials sector, although they're on fire. They're doing really, really, really well. Thus far in the last 4 weeks, with regards to the projections I made the last time I was on your show, I look quite stupid, and I hope I continue to look stupid. I don't think I will, though. The industrial materials sector is tied to the economy. And my belief is that the economy will continue to weaken irrespective of the equities market. Unwinding a 10-year economic recovery that was fueled as much by liquidity as anything else, and getting past the damage done to the global economy by the COVID-19 virus, never mind economic nationalism and trade wars around the world. I think we have some real headwinds. Now, those headwinds set up a tremendous opportunity. Might be 2 years out, 3 years out, 4 years out, 5 years out. I don't know. If we have the economic slowdown that we're talking about, coming after a period where industrial materials and base metals were already weak, if you take base metals and industrial materials and put them through a 5 or 6 year bear market, what you do is balance supply and demand by impairing supply. And as the economy begins to recover of its own volition, 3 years, 4 years, 5 years from now, and tightness begins to develop in industrial materials markets, the prices can really fly. Because if you impair the industry's ability to produce, they can't meet market signals by increasing production. If you remember back to 1999 and 2000, many of your viewers won't, but if you remember back to that period of time when frontier markets, in particular China, were beginning to grow, and demand for resources began to come into the market after a huge decade of underinvestment in the 1990s, there was simply no supply to meet that demand. And you had things like the oil price go from $18 to $100. The uranium price go from $8 to $140. When you meet supply and demand by cutting supply and demand returns, truly strange things happen. And my suspicion is this will be across the board. I mean, my suspicion is that you'll see another cover on The Economist magazine, probably with Greta's pretty face, talking about the end of oil, with the oil price hovering around 25 or 30 or some number like that. And that'll set up a move into the $80 or $90 range. We suspect, as an example, that peak oil demand happens in about 2035.
Year 2035, okay.
Yeah, sometime like that. And that presents real challenges in a world where supply is falling fairly rapidly. And I don't want to pick just oil. I think that uranium will do well. I think that nickel will do well. I think that copper will do well. But I don't think they'll do well in the near term because they're economically sensitive.
Well, Rick, we have more questions than we'll have time to ask you. If you could just remind people how they can reach you, and if you want to re-up your offer to grade their portfolios at this time, or are you still so backlogged that it would be imprudent of us to extend that offer at this time?
No, for those subscribers who have patience and a sense of humor for my tardiness, I love talking to your subscribers and listeners. As an incentive to get people to talk to me, I happily grade natural resource portfolios. If you go to our web link, www.sprottusa.com/rankings, enter your natural resource portfolios in the ranking list, ask any questions that you care to ask, and we will send you back the rankings. And we will send you back a 45-year Barron's Gold Mining Index equity chart, which is the best visual representation of where we are in this market relative to past markets. And additionally, we'll send you a 100-year commodity chart, which I think shows very well the value exhibited by commodities relative to the rest of the economy, and why I think that the rally that we will ultimately enjoy in commodities, to quote a very rude phrase, will be a rip your face off rally 5 years or 4 years, 5 years, 6 years from now. Once again, sprottusa.com/rankings. Please be patient. I've worked myself down to only an 1100 rankings backlog.
It's remarkable, but our people appreciate it. Some of those comments that I didn't read were that saying people thank you for having ranked their portfolios in the past. We've been speaking with Rick Rule, the CEO of Sprott Asset Management. Rick, as always, thank you for joining us on Liberty and Finance.
Pleasure, and thank you so much for your and Andy's contribution to our conference a couple of weeks ago. I know it was a time and technology challenge, but I think we all acquitted ourselves reasonably well.
It was a true privilege and an opportunity, and we're still seeing the fruits come from the relationships that were formed there. So people really appreciated that. And I've heard them say, even if we get the physical ability to have a conference next year, that they saw some extra benefits from having the virtual element available.
I really hope that we have a physical conference next year. there's a lot about a physical conference, not the least of which is cruising around Vancouver Harbor drinking wine in each other's company, that I like. But certainly, if we have a physical conference, there will be a virtual overlay. The idea that people who can't afford the time to come visit us in Vancouver but could attend virtually was a real privilege for me for this conference. There were people from something like 30 countries this year. The second thing is, and we talked about this before, it frees me from the tyranny of time. There are things that we can do, like holding several workshops simultaneously that people can toggle back and forth. And of course, this conference will be preserved as an archive for 6 months so that anybody who attended this conference won't have to buy an MP3 or anything like that. They'll be able to go back and re-refer to it. So certainly the conferences of the future will be hybrids, virtual and physical conferences.
Well, we'll be looking forward to that. It was a great opportunity, and just thank you for coming back on the show.
Pleasure. Always a pleasure. Thank you.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.